You've been taught to fear the stock market like it's some unpredictable casino where people lose everything overnight. But that fear is widely exaggerated, deeply misunderstood, and in most cases, completely backwards because the real risk isn't investing, it's staying out and letting time pass while your money quietly loses value. And once you understand how the market actually works instead of how it's portrayed in headlines, movies, and panic driven conversations, you realize that most of the fear it comes from a lack of context, not actual danger. Because the stock market is not a slot machine, it's a system built on ownership of real businesses that produce real profits over time. And when you buy into it, you're not gambling, you're participating in the growth of the companies that power the economy. And the reason people get scared is because they focus on short term movement instead of long term trends. And they see prices go up and down daily and assume that volatility it equals danger, when in reality, volatility is just the price of admission for long term growth. And if you zoom out instead of obsessing over day to day fluctuations, the pattern becomes obvious. Every time the market trends upward because businesses grow, innovate, and generate more value, and that upward trend has been consistent across decades despite recessions, wars, crashes, and global uncertainty, which means the real question isn't whether the market is risky in the short term, it's whether you're willing to think long term enough to build and benefit from it. And most people aren't, because they have been conditioned to react emotionally to temporary drops. They see the red numbers and immediately assume something is wrong, when often it's just normal market behavior. And this emotional reaction is exactly what causes people to lose money and not the market itself, because they panic and sell when prices drop and then hesitate to buy back and when prices recover, effectively locking in losses and missing the gains. And this cycle repeats over and over because they never learn to separate emotions from the strategy. And the truth is, the market doesn't punish patience, it rewards it. But patience is hard when you don't understand what you're holding. So, one of the fastest ways to eliminate fear is to educate yourself on what actually you're investing in. Because when you understand that your own pieces of companies that sell products generate revenue and expand over time, it becomes much more easier to ignore the short term noises and focus on the long term growth. And another reason people are scared is because they think they need perfect timing to succeed. They believe they have to buy at the lowest point and sell at the highest point, which creates pressure and hesitation. But timing and market consistency is nearly impossible, even for professionals. And the irony is that trying to time the market often leads to the worst results than simply investing consistently over time, because consistency removes the guesswork. It allows you to buy through both highs and the lows and averaging out your cost and reducing the impact of volatility. And this approach, often called dollar cost averaging, turns market fluctuations from something to fear into something to use. Because when prices drop, you're effectively buying at a discount. And when prices rise, your previous investment grow. And over time, this creates a compounding effect that becomes incredibly powerful. But compounding requires time, and time is exactly what fear causes most people to waste. And because they delayed starting, they wait for the perfect moment, and that moment rarely comes. Or when it does, they're too uncertain to act, so they stay on the sidelines while the market continues to move. And what they don't realize is what missing just a handful of the best days in the market can significantly reduce the long term returns. And those best days, they often happen close to the worst days, which means if you try to avoid downturns by jumping in and out, you risk missing the recovery that follows. And that's why staying invested is so important. Not because it feels uncomfortable or comfortable, but because it works. And another major source of fear is media influence, because negative headlines get more attention than positive ones. So you're constantly exposed to the worst case scenario, the crashes and the predictions of doom. And while downturns do happen, they are temporary and they're part of the cycle, not the end of it. But if you're only consuming information that highlights the negatives, your perception becomes skewed and you start to believe that the market is more dangerous than it actually is. And this perception, it drives the hesitation, which leads to inaction. Inaction is what truly costs you, because while you're waiting, inflation is eroding your purchasing power, meaning the money sitting still is actually losing value every time. So the safe option of doing nothing is often riskier than investing. It just feels safer because the loss is invisible and gradual instead of visible and immediate. And that's what it makes deception or deceptive. And another misconception is that you need a lot of money to start investing, which creates a barrier that keeps people out. But in reality, you can start with small amounts and build over time because the key factors isn't how much you start with. It's how consistently you contribute and how long you stay invested. And the earlier you start, the more time compounding has to work in your favor, which means even small investments can grow significantly over decades. And this is where mindsets become critical because if you view investing as a long term process instead of a quick win, your behavior changes. You stop reacting to short term movements and start focusing on consistency, discipline, and patience. And those traits are what separate successful investors from everyone else. Not intelligence, not luck, but the ability to stick with a plan despite uncertainty. And one of the simplest ways to build the plan is to invest in broad market index funds, which give you exposure to a wide range of companies instead of relying on a single stock, reducing the risk of diversification. And it allows you to capture all the overall market growth without needing to pick a winner. In this approach, it removes a lot of the complexity that scares people away because you're no longer trying to outsmart the market, you're aligning with it historically. And then alignment has produced strong long term results. And as you continue investing, something interesting really happens. Your perspective shifts. Instead of fearing downturns, you start to expect them. You understand that they're temporary and often create opportunities. And this shift reduces emotional reactions, making it easier to stay consistent. And consistency is what drives the results, not perfect decisions. And another important factor is your time horizon. Because the shorter your timeline, the more volatility matters. But the longer your timeline, the less those fluctuations impact your overall outcome. And this is why the market feels risky to people who are thinking in weeks or months, but feel far less risky to those thinking in years or decades. Because over long periods, the noise smooths out and the underlying growth becomes clear. And if you align your expectations with that reality, the fear starts to fade. And you begin to see the market not as something to avoid, but as a tool to build wealth over time. And that's ultimately what it is, a tool, not a threat. But like any tool, it requires understanding and proper use. And when used correctly, it can be one of the most effective ways to grow your financial future. And the biggest obstacle isn't the market itself, it's your reaction to it. Because fear leads to hesitation. Hesitation leads to missed opportunities. And missed opportunities compound just like investments do, but in the opposite direction. And if you want to break that cycle, you need to replace fear with knowledge, replace hesitation with action, and replace short term thinking with long term perspective. Because once you do that, the market stops being something that scares you and starts becoming something that works for you. And the longer you stay consistent, the more obvious it becomes that the real danger was never the market. It was staying out of it in the first place. Thanks for watching today. If you found value in today's video, please subscribe. I can't grow this channel without the subscription base, and I really desperately need the subscriptions right now. Also, comment down below if you want to. I'd love to talk to everybody. I'll respond to any positive comment that's listed down below. And if it's negative, yeah, just go away. Also, check out this video to your right. It can help you on your financial journey as well. And we will talk to you guys tomorrow. Have a good day.